With over 30 years of investment experience, I've weathered my share of ups and downs. Even though there were no guarantees when it comes to investing, the one constant I've seen is that people flock to safe haven assets when times get tough, and gold is at the top of that list. Used as a means of exchange longer than any other currency ever created, it offers benefits you can't find with other investments, which we'll discuss later. When it comes to this precious metal, you have many options. Metal streaming and royalty companies are another option when looking to diversify with alternative investments. They pay an upfront fee to a miner in exchange for a percentage of the revenue and the right to purchase the metal from a specific mine at a guaranteed price. These companies are well positioned to benefit from rising gold prices without the risk of or overhead of running a mining operation. Also, they provide greater diversification than a pure mining play, as most will invest in many different mines. In the event one fails, they still receive revenue from the other ones. Furthermore, many invest in mines at different stages of operation. This minimizes the downtime and startup costs associated with bringing new mines online. However, these companies come with their own set of risks too. One of the main risks is that they need a lot of capital to purchase mining rights. They can raise money by taking on new debt or issuing new stock. If they take on debt, the company is responsible for interest payments and repaying the principal. If their mines are profitable, no problem, but if not, the company must pay back the debt from its cash reserves. Some companies prefer a debt-free balance sheet, so instead of taking on debt, they issue new shares when they need to raise capital. This dilutes the ownership of the company. If the mine is successful, the increased profits will offset the increased number of shares, but if not, the share price will suffer. Also, they need to ensure that they invest in the right mines. If they choose poorly, it can significantly impact their profitability. One major player in the sector is Franco-Nevada Corporation. This Canadian-based company has a diversified portfolio of mining agreements, with gold making up 55% of its total revenue for the third quarter of 2022. Franco-Nevada generates a significant amount of cash flow from its mining agreements. They use this cash flow to fund new contracts and increase the dividend paid to shareholders. In fact, the company recently reached a milestone of increasing its dividend every year since its IPO in 2008. That's 15 consecutive years. The company also has a debt-free balance sheet, a rarity in the mining industry. Though past performance does not guarantee future returns, its stock price has historically outperformed other gold mining stocks and even the price of gold, so it might be something worth considering. Reasons to invest: diversification, lower operating costs, benefits from rising gold prices, wider margins than gold miners, and lower overall risk. Reasons to avoid: may dilute shares or take on debt to raise funds, and management decisions are critical in selecting profitable mining operations. Precious metals may be right for some investors, not for others. If you're looking to maximize your returns without regard to risk, it may not be the best choice for your goals. However, with the economic and geopolitical challenges we're facing now, this year may turn out to be the best one to diversify with gold and silver. If protecting your wealth from the ravaging effects of inflation is important, consider adding one or two of these investment ideas to your portfolio. Personally, we prefer diversifying with a precious metals IRA. And if you like this option too, then start by grabbing your free Gold IRA guide in the description box below. And if you're experienced in this area, which precious metals dealers do you like to deal with? Share your thoughts in the comments section below.